And there's many reasons why traders avoid these. Hi, welcome back to Let's Talk Forex. I'm Alison.
And I'm Chris, and today we're talking about something a little bit off the beaten track. We're talking about trading miners and exotic currency pairs. And I think that's something we've touched on previously, Alison, but I don't think we've ever actually done a deep dive into it. And the question I think we're going to be asking here is, are there really good trading opportunities, or are they really too risky to be bothering with?
Yeah, I mean, most traders stick to pairs like the Euro USD or, the GBP USD, but there's a whole world of other instruments that are, present good opportunities. These include pairs like the USD ZAR, the dollar South African rand, and the Euro Turkish lira, for example. But, of course, they offer good opportunity, but often they're high risk as well.
Yeah, so today we're going to be talking about what makes these pairs different, and why some traders really love trading them, but also talk about the risks about them. And if you are going to trade them, we're going to talk about how to trade them without blowing up your account.
So, if we get into what exactly exotics are, they are, well, if we look at the major pairs, they always include the US dollar and another major global currency such as the euro. So examples of major currencies are the Euro USD, which is something we speak about a lot, the USD JPY, and then the GBP USD. And these pairs are the most traded pairs in the world, and they're also the most liquid pairs in the world.
Yeah, exactly. Minor pairs, on the other hand, don't include the dollar. So these are things like the Euro GBP or the Australian dollar to the Japanese yen. So these are still relatively liquid. As you said, they're still major currencies that we're dealing with here, but they don't dominate volume the way that major pairs do.
Yeah, and this is, I guess, where it gets spicy. These pairs are made up of one major currency and then a currency from an emerging market or from a smaller economy. So, for example, the USD TRY or the Turkish lira, the USD MXN or Mexican peso, and then the Euro ZAR from South Africa. So you won't hear about these pairs as much as you do the major currencies.
Yeah, and exotics are pretty weird. They tend to have low liquidity. They'll have very wide spreads, and they can have really wild price swings as well. But, for some traders, that's the whole appeal, is seeing that price volatility.
So what we're going to talk about in this episode is just about that, about the volatility, and we're going to talk about their moves and then also their potential profit per pip, because obviously this can be much higher than with the majors.
And another advantage, I think, of trading miners and exotics is the diversification here. So if you're already trading the Euro USD and you're comfortable trading the Euro USD or, another major pair like the GBP USD, then you're going to find those two pairs are often going to move in the same direction. They're correlated. They're closely correlated. But let's say, you want to trade instead the USD to the Singapore dollar or the euro to the Polish zloty, then you're tapping into very different economic forces. So you can really diversify your trading setup.
Yeah, exactly. And also because these pairs aren't plugged into like institutional algorithms, a lot of traders feel like they've got an edge with these pairs. So, if they're plugged into regional news or the macro trends of a particular region, then they obviously have a little bit more insight into the movement of these pairs, and therefore they feel like they can really take advantage of that opportunity.
Yeah, exactly. So if you're following emerging markets closely, you might spot a move in the Turkish lira or the South African rand before the rest of the broader market reacts. So this can be really useful if you're zeroed in on regional news.
But of course, and I know it's something we've mentioned many times before, there higher risks with trading exotics, and there's many reasons why traders avoid these exotic pairs because the risks really can be significant.
That's right. Yeah, there's a lot of risk here. The first one is low liquidity. So unlike major pairs, there just aren't as many buyers or sellers in these exotic pairs. And this can lead to really wide bid-ask spreads. You come 20, 30, sometimes even 50 pips. So it's the probably the main risk here involved is your spread risk.
Yeah, exactly. With these huge pip spreads, you're going to be starting deeper in the red, which means that you really need this pair to move quite significantly in order to just make a profit on the pair.
Yeah, exactly. And then there's the slippage. So in volatile conditions or low volume periods, your order is probably not going to be filled at the price you wanted. So this can really mess with your stop loss or your take profit levels.
Yeah, and then you don't want to forget your trading costs. So overnight swap fees might be very expensive. So if your trade is profitable on paper, but you're holding the trade for a few nights in a row, the swap fees might really wipe out your profits as well. So that's something to really be aware of when when you trade these pairs overnight.
Yeah, it's true. It is an important point because swap fees on the major pairs are small, almost insignificant in a lot of places. But yeah, don't be caught out by the swap fees on these exotics who are going to trade them. It's also worth talking about the volatility in these pairs. Like these currencies, emerging market currencies, are often heavily moved by political instability, local elections, or surprise central bank actions. A good example is the Turkish lira. It's seen single day losses of over 10% in recent years at some points. And this is just from political interference in monetary policy. So if you can be caught out very easily if you're not really tuned in to the local market.
Yeah, or you want to think about what happened to the Russian ruble during the early days of the Ukraine conflict. We saw the currency collapse within a matter of days, and even traders who had stops in place really struggled to get out of their positions because nobody's wanting to buy it.
Yeah, exactly, because there's no liquidity. No, yeah, so you've got to be very careful of these things. And it's important pointing out it's much harder to apply standard technical analysis to these pairs. The charts don't behave the way you do with high volume pairs. You're going to get more gaps. You get very choppy candles. You get fake outs, and patterns just won't hold as well as they do on something like the Euro USD.
Yeah, I mean that unpredictability can really frustrate traders who rely on technical indicators like the RSI or the MACD to get in and out of positions. Your setups might look perfect, but then they completely fall apart. Even though it looks like it's going to work out well.
Exactly. So the bottom line here is that exotic pairs, yes, they can be profitable, but they require a different mindset and they require a lot of local knowledge and a much more cautious risk management.
Yeah, absolutely. So I guess the question is then, when do you, venture into exotics, and when do you just stick with major pairs?
Yeah, so I mean, I think we've talked about this for majors. We always recommend that beginners start with major pairs, and if you're going to be scalping or anything like that, anything that's high frequency, then you probably want to stick to majors because you want tight spreads and you want a fairly predictable price action. Major pairs are also ideal for trading big economic news, like Fed rate decisions or ECB statements.
Exactly. And then you might look at exotics if you're trading the regional stories. So if you really understand what's happening in that region and you're following those news stories very closely, then you might want to venture into exotics. So if you're watching the elections in South Africa, for example, you might want to trade the USD ZAR, or if you're looking at inflation in Mexico, then it might be a good idea to trade the Mexican peso, because these pairs do respond very sharply to local developments.
Yeah, and just got to be sure to adjust your position sizing and your risk management here, because what works for the Euro USD is not going to work for the USD versus the Turkish lira or something like that.
So now we just want to get into a few tips for trading exotics. So if you're still interested after hearing this in trading exotics or minor pairs, then these are some battle-tested tips to keep you safe.
Yeah, exactly. So the first one here is to know your session timing. So exotic pairs are much more focused. So, the Euro USD is always going to have liquidity pretty much any time of day or night. But something like the USD ZAR or the USD to the Singapore dollar, these are going to move mainly in local market hours. So if you're trading the USD to the Singapore dollar, then you really want to be trading the Asian session. And if you're trading the USD to the ZAR, you're going to be wanting to trade probably the London session because the South Africa time zone is very similar there. So yeah, you've got to be very aware of these timings here.
And next, of course, you need to get familiar with your local news sources. Major outlets like Bloomberg, for example, are probably not going to cover the Hungarian forint or the Chilean peso. But regional publications or even central bank websites will be covering regional news. And they often post in English. And they'll give you a heads up on potential, risk events. So just be aware of what is available in that region from a news point of view.
Yeah, really important to get your regional news sources correct. You also want to adjust your risk per trade. As we talked about, they're going to have wide swings in these pairs. So a tight stop loss isn't going to work here. Yeah, you might need to set a stop of 100 to 200 pips sometimes, and this means you have to reduce your lot size because your total risk in dollars is going to be much larger with a stop like that.
So generally, a good rule of thumb is that if you normally risk 1% or even 0.5% of your account with each trade, then stick to that, but recalculate your position size to accommodate for your larger stop so that you're not risking more than you usually would on each trade.
Yeah, exactly. And then, as you said, check the swap fees before holding any kind of position on exotics overnight. Some brokers will offer positive swaps on exotic pairs, but this is not always going to be the case. So you really need to pay attention, and you might be paying a lot just to keep your position open. And so you really want to be aware of that before you hold anything overnight.
Absolutely. And another thing, and I know it's something we mentioned again, we mentioned just now, is just be aware of news announcements. Exotic pairs are particularly sensitive to surprise announcements. So if Mexico's central bank announces a surprise rate hike, then, you could find a huge gap in the USD Mexican, and spreads could also widen dramatically with this announcement. So just be very aware, and our advice is always, if you don't know the pair very well and you see there's a news announcement coming out, you might want to even close your position just to protect yourself.
Yeah, and I think that's especially important here. And taking all that into account, I think the number one thing here is you want to test everything on a demo account here first, especially if this is your first foray into trading exotics. Try it on a demo, get used to the volatility, the slippage, and the personality of the pair. Watch it for a few days, get a good understanding of it.
Yeah, because every pair basically has a personality and has different rhythms. And the exotics tend to have a shorter fuse and tend to be more volatile.
Yeah, exactly. So and I think the main point here is you got to approach exotic pairs with a lot of respect. And if you don't approach them cautiously, and then they can teach you a very hard lesson.
Yeah. Definitely. So to sum up, exotics and miners can add excitement and profit potential with their volatility, and they can also help you diversify your trading strategy.
Yeah, exactly. But they do come with much higher costs, much more unpredictable price behavior, and unique risks. And each one is going to have a unique risk to it, depending on the country. So they're not for everyone. They're certainly, I would say, not for beginners. But if you do your research and you manage your risk, they can be really powerful tools and can be very profitable.
Thank you so much for tuning in. If you have an exotic or minor pair that you're particularly good at trading, or that you may want to avoid like the plague, let us know. Drop us a message, and thanks for tuning in.
Yeah, thanks so much. Don't forget to subscribe and leave us a review, and as you said, write us a note in the comments if you've got any questions. And I'll speak to you next time, Alison.
Cheers, Chris.